the market prognosticator.
Oil prices continued lower overnight, with Brent now 22% lower than its September high. This decline indicates slowing demand from a weak global economy, a lack of OPEC unity, and a boost to consumers in oil-consuming countries. The dollar was up and the pound weaker as UK and US 10-year yields lowered further, converging on the 4% level, which is 80 basis points lower than the August highs. Together, these data points indicate a continuing easing of financial conditions globally, which is positive for financial markets. China's reported trade data are mixed, but offer no respite from the deflationary feel evident elsewhere. In the UK, smart metering systems has received a recommended offer from PE giant KKR at a 40% premium, valuing SMS at £1.3 billion. The relentless takeover of the UK mid-market continues. Publisher Bloomsbury updated that its revenue is now expected to be comfortably ahead and profits materially ahead of current market expectations. Energean, the oil and gas producer focused on the Mediterranean, announced its entry into the Moroccan offshore market via a farm-in agreement over AIM-listed Chariot's gas developments and its associated exploration acreage in offshore Moroccan waters. This new country entry for Energean is well aligned with its strategy. The deal includes $10 million upfront, with an option to increase its working interest to 55%. The conflict in Israel and Gaza has impacted Energean's share price amid concerns that the conflict could spread. Its main Karish offshore Israel gas asset has remained operational, and it derives most of its income from fixed-price commercial offtake agreements with Israeli utilities, thus protecting it from the effects of the lower oil price. This new country entry is welcome for Energean as a sign of sensible long-term growth and a path to diversifying risk in its capital allocation. Elsewhere, the Kelso-THG debate rumbles on today, with Kelso issuing another announcement urging the larger THG to break itself up, citing evidence of much higher nutrition business valuations elsewhere. And finally, SDI has reported that its H1 revenue increased marginally despite the expiration of large profitable COVID contracts. SDI acquires private companies at discount values to those on quoted markets. These subsidiaries are then encouraged to grow for the benefit of all shareholders. It reports that it has several new acquisition opportunities under review, so despite headwinds, it remains confident about the future. There is a link here to a progressive note below.
Progressive Equity Research.